Imagine waking up one morning to see the markets in free fall, billions wiped out in minutes, and panic spreading like wildfire. It's happened before: 1929, 1987, 2000, 2008. The question is it about to happen again? Are we standing on the edge of another devastating crash, just waiting for history to repeat itself? Let's take a closer look at the warning signs and uncover the truth. To make sense of today's situation, I find it essential to reflect on past market crashes. The Great Depression in 1929 was the most severe downturn in modern history, sparked by a stock market crash. Factors like speculative trading, over-leveraging, and insufficient regulatory oversight played a significant role. Then there was Black Monday in 1987, when global markets experienced a sudden crash, with the Dow Jones Industrial Average dropping 22.6% in just one day due to computerized trading and market psychology. The dot-com bubble burst in 2000 serves as another reminder of how quickly things can change. The late 1990s were marked by rampant investment in internet-based companies that were often overvalued and unprofitable, leading to substantial losses when the bubble popped. More recently, the global financial crisis in 2008 was triggered by the collapse of the housing bubble in the US, resulting from risky mortgage lending and complex financial instruments. This crisis forced major banks to fail and prompted government intervention to avoid complete economic collapse. Looking at the present, I see several warning signs that suggest we might be heading toward another crash. For one, many analysts are pointing out that stock markets appear overvalued, with price-to-earnings (P/E) ratios at historically high levels, leading to concerns about an inevitable correction. Rising interest rates, as central banks, including the Federal Reserve, increase rates to combat inflation, can dampen consumer spending and corporate profits, negatively impacting stock prices. Geopolitical tensions, such as the ongoing war in Ukraine and trade disputes between major economies, also create uncertainty in the markets, often foreshadowing downturns. Additionally, the extreme volatility of cryptocurrencies like Bitcoin and Ethereum adds another layer of complexity, raising questions about their impact on traditional markets. Record high debt levels among corporations and governments make economies more vulnerable to shocks, increasing the risk of a market crash. While it's clear there are parallels between today's conditions and those leading to past crashes, I remind myself that history doesn't always repeat in the same way. The global economy is in a constant state of evolution, influenced by new factors such as technological advancements, shifts in consumer behavior, and changes in regulatory frameworks. Moreover, the lessons learned from previous crashes have led to safeguards designed to prevent history from repeating itself. Regulatory reforms post-2008 have made the banking system more resilient, and central banks have adopted more proactive measures to manage economic risks, such as quantitative easing and forward guidance. Given this uncertainty, I consider what strategies I can employ to protect my investments. Diversification across different asset classes, sectors, and geographies is one effective way to mitigate risk. Focusing on high-quality investments, companies with strong balance sheets, consistent earnings, and competitive advantages, can help me weather economic storms. Staying informed about market developments and economic indicators allows me to make more informed decisions, and avoiding panic selling during downturns is crucial. It's easy to get emotionally caught up, but impulsive decisions can lock in losses and prevent me from benefiting from potential recoveries. Keeping my long-term goals in mind helps me navigate short-term volatility, reminding me that while market crashes can be unsettling, history shows that markets tend to recover over time. In conclusion, while the risk of a market crash is ever present, I approach it with a balanced perspective. History offers valuable lessons but isn't a foolproof predictor of future events. By staying informed, diversifying my investments, and focusing on quality, I position myself to better handle whatever the markets may bring. Ultimately, I understand that markets are inherently cyclical, and by maintaining discipline and a long-term perspective, I can navigate the storms and emerge stronger on the other side. And that's it for today's video. Market crashes are always a hot topic, and while history gives us clues, the future is never set in stone. The key is to stay informed, think long-term, and avoid panic-driven decisions. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell so you don't miss future updates. Let me know in the comments what you think. Are we heading for another crash, or is this just another market cycle? Thanks for watching, and I'll see you in the next one.